Hello, I'm Neil Wilson, and welcome to the keynote conversation for this third and final series of this year's symposium. We're going to be talking today with someone I've known for almost 20 years, since back in 2001, when after he left Tudor, he was one of the two co-founders of Trafalgar Asset Managers, which I watched grow in assets from $6 million at launch to more than $3 billion at its peak. Despite being affected, like many, by the tidal wave of redemptions that hit with the financial crisis of 2008, Trafalgar was one of those select firms that came through that challenge with flying colours and some very strong performance. Not least, perhaps, because Lee, as the CIO, was such a contrarian thinker, or how he likes to describe himself as a non-linear thinker, which perhaps we can get into later. Anyway, after going his own way to set up Altana Wealth in 2010, he has been a pioneering figure, not least with the launch of the Altana Digital Currency Fund in 2014, which is, we believe, the first active crypto fund on the market. Altana is a London-based FCA-registered management company, although it also has offices in Luxembourg and Monaco, from where Lee is joining us today. Over the next 45 minutes or so, he plans to touch on a variety of topics, including the state of the play in global markets, of course, given the background of the COVID pandemic and the official policy responses to it, and some other things like distressed market opportunities, including one which Lee regards as probably his favorite trade, and the Global Billionaires Fund, something which Lee has created. We're going to talk about the concept and thinking behind that. And SPACs, special purpose acquisition vehicles, and how Lee is playing those. Anyhow, to get started, maybe we should begin with that macro outlook and with the global policy responses to the pandemic and where that is leaving us at the moment. I suppose the most obvious starting question is, with the huge stimulus we've been seeing, are we in a kind of QE ad infinitum, and where is that going to lead for markets? So, Lee, do you want to kick us off on that?
Thank you for inviting me today, and thank you for everyone who's listening in. Hopefully, I can be thought-provoking for you today. QE ad infinitum. Actually, one of my good friends said to me, I think maybe 7 or 8 years ago, that there'll be more QEs than there were Mission Impossible movies, and so far it's a close-run thing, and I think he'll probably be right. Where does it lead? When we set up Altana, I think one of the key things, and I think the key things we always think about, is our exit from trade. I mean, how do we get our money back? Do you post a redemption notice? Do you get paid back because of a merger or a liquidation, or do you have to trade in the market? How do you get your money back? As anyone in South Africa will tell you, that can also include capital controls. That can also include offshore, onshore. It's not an easy world with capital controls in the UK until I think 84. How do you get your money back is also, what do you get it back in? And there's no point getting your money back in, devalued, Venezuelan dollars, right? So Venezuelan pesos. So how you get your money back is important. So when we looked at the QE ad infinitum, which of course is the easy solution for all governments, because, it's not on my watch, the problem is later. The pressure valve is the currency. And so if you keep printing money, it's the currency that kills you. So if you invest in UK property and it doubles in value over 10 years, but the Swiss franc more than half versus the Swiss franc, there's been a bad investment as a Swiss investor. So the currency is key, and we're going to see, in my opinion, at some point in the end game, you're going to see something a bit like the Asian crisis, where one of the currencies goes badly wrong and several other follow, and we've seen that already. I mean, Brazilian real has gone from 2 to 5+, Turkish lira above 8. We don't need to talk about the South African rand with this audience. They're all fully aware of where it was 10 years ago. But Indian rupee has massively devalued versus the Chinese renminbi, two of the world superpowers. Russian ruble, it was not long ago at 20. So the currency is a big issue, and one of the things I'm pushing people to think about, and one of the things that I've been wrestling with, is how much anti-fiat do I have in my portfolio versus fiat? You know, how much hard currency? You know, it can be gold, diamonds, you know, Norwegian krona. It can be hard currencies, Singaporean dollar, and how much do I have in, you know, dollars, euros, pounds, Japanese yen, the more traditional, you know, currency-based investments. And do I want to be in those countries if their contract law is going to prevent me from taking the money out in the future?
That's an interesting question. So,
it's a vital question, Neil. It's a vital question.
Yes, it is. I mean, in terms of, I mean, I know you've got some specific things that you want to say about various of these currencies, including the China and the renminbi and gold as well. But is it should we move straight on to fiat versus crypto as the central choice that you're thinking about? Is that the thing that's uppermost?
Yeah, let me just expand on the fiat. I think fiat traditionally means gold, silver, platinum, you know, maybe diamonds, maybe art, maybe some of these other hard assets, but typically gold, silver. And one of the things that I spent a lot of time on last year was my gold allocation. And I've sort of taken a view that if we have massive devaluation at some point in the future of major currencies, specifically the dollar and euro, how much would I lose on my portfolio? And so if you have 5% gold, which is your benchmark number, and your other 95% is in fiat, and that fiat falls by 90%, you know, you've lost 90% on 95%, and you've maybe trebled your money on gold. So you've maybe made 10%. That's a terrible trade. So it's the wrong allocation. If you put 90% in gold and 10% in fiat, but you're wrong, or you don't live long enough for yourself to be right, the gold halves in that period, you've lost 45%. So 90 is the wrong number as well. So there's a number in between, and it's different for different people. But for me, I came up with a number that I wanted 25% to 30% in anti-fiat, and with a view that that would treble in value versus fiat, and therefore I'd make 50 to 50+%, and I'd lose, you know, 50 to 60% on my fiat part of my portfolio, so I'd still do relatively well. And that's where I came up with my anti-fiat portfolio. Inside the anti-fiat portfolio, what do I put in it? And clearly crypto, being particularly Bitcoin, being, you know, a limited number of coins available, is a part of your anti-fiat. And then it's a question of what percentage of your anti-fiat is gold, silver, crypto, and for some people it's platinum and different things. So I don't think it's an either-or choice, Neil. I think it's you don't have to choose one or the other. It's a question of how much you allocate to each one. I think in your, you know, specify your anti-fiat portfolio and then allocate accordingly. And I have more gold than I have crypto for that reason.
Interesting. For the enthusiasts in crypto, and I've written some stuff about this recently, typically people would say, well, because of the volatility and the challenges of the market, a 4, 5, 6% allocation is probably about the right level for crypto. You're thinking it's much larger than that, even if you have a lot of gold. Is that correct?
No, I don't think so. I think for some people it's 1 to 2. Let's face it, the benchmark number is, as it stands today, is about 0.25% of global wealth equivalent is crypto. It's a small number. So you're already overweight at 1%, whereas gold is your 5%. So if I'm talking 25% as my anti-fiat, yes, I think, you know, you're talking 2 to 5% in crypto. I think if you're going bigger than that, I have no problem with that. And, you know people like Raoul Pal, you know, have said go 80% in crypto. But it is stomach churning, and you've got to be somebody who can withstand. I mean, we've seen last year crypto go from 8,000 to 4,000 to 6,000 to 4,000 in 48 hours. I mean, this is a rocket ship attached to a rocket ship. It's the most volatile thing I've ever seen trade in my whole career, and I've traded for nearly 30 years. So, you know, this is, if you can stomach the drawdowns, yes, of course. But for gold, the drawdown is maybe 40, 50%. You know, it's not, you can allocate more easily to that number. So I still think it's probably under 5 is my view to crypto. but it's not zero.
Okay.
And similarly, gold is not zero either. And I hope I'm
think,
wrong, Neil. I want to say I hope I'm wrong. I really do.
Yes, obviously. I mean, I watched some of the. We had a macro panel on this event in the first series, and people were talking about how the degree of QE and the fiscal deficits have gone. Like, it used to be the case that if you were over 100% debt GDP ratio, it was a major problem. Over 120, it was close to game over, or whatever. That kind of numbers are being put out there. Everybody's going in that direction now. So is there and can it all be washed away by modern monetary theory and the central banks writing it off what they've put in, or is there any way out of it, or does it all end in a massive car crash in the end?
I think it's possible that you can have a concerted grand reset across Western society. Everyone does it at the same time. But it's still hard to see how you don't have losers. I mean, if you print more money and the price of assets go up, you get more inequality. If you default on the debt, you kill all the holders of the debt. If governments keep buying debt ad infinitum, then why do they need to tax you? At which point it gets worse and worse. And as inflation comes in and you have to raise rates, can you attract foreign capital? So at some point, one of the weaker countries falls over. And, I'll give you a good example of something really not discussed at the moment. Is in 1999, when the European Union came together, Germany and France had approximately 180% total debt. I'm not talking sovereign debt, I'm talking total debt, corporate sovereign, domestic, to GDP. So about the same number. Before COVID, a year ago, Germany was still at 180%, but France has gone all the way up to 325%. This is pre-spending on COVID. So would the Germans allow the French to reset, even though they've had the benefit of all that spending? I mean, it's a political nightmare. So I don't think it can end well. And I think it has to be forced upon countries by currency devaluation. And only with a gun to their heads, aka Greece before, did they make changes. And so, no, I don't think it ends well. And I keep saying I hope I'm wrong, but that's why your anti-fiat today needs to be a lot higher than it was pre-COVID.
One of the things I mentioned at the outset was the digital currency fund that you run is the first kind of active one in the market. There are others that are passive, long only. Your fund has the capacity, like a hedge fund, to go long and short, trading different things. But given the volatility, you've been very cautious with it so far. Is that going to be your approach for the foreseeable future? And how do you view Bitcoin versus Ethereum or the other coins?
I think cautious is not a word I would use in the crypto space because it can move 10% a day. But I took the view, Neil, that blockchain was going to be something really big. But I didn't know whether it would be Bitcoin, Ethereum, something else. And I felt that it was a very early version of a very, very clever technology. And so I didn't know who was going to win us. So Alistair, who runs the fund for us, I wanted someone who was active, who was watching the growth in digital wallets and watching what would happen, the forks, the new things coming. And then the great thing about blockchain is it's transparent. So you could see if a newcomer was going to be big and see if it was being used and the turnover and how many new wallets and everything else. So I wanted to know, do I own MySpace and it's going to be overtaken by Facebook or not? So I wanted to be active between the coins. I don't know who's going to be the winner. I also felt that exiting the trade was something that was going to be difficult because all well and good having a 1% allocation like I did to start with, but then if suddenly it's at 10%, what do? Do you take profits? Do you keep going? And I wanted somebody to be watching it 24 hours a day, 7 days a week, because it trades 24/7. This is not a 250-day-a-year S&P or a volatile emerging market that trades 250 days a year. It trades 365 days a year, 24 hours a day. It trades 250 days at 9 hours versus 365 at 24. You're looking nearly 3 times as long, right? There's 3 times as much trading opportunity. It's not something you want to be doing passively, going to bed at night and waking up with alarms every time it moves a few percent. So I wanted somebody watching it, and I wanted to be able to trade NAV. I didn't want to be in closed-end fund that would trade at a premium or discount. So that's kind of why we set it up. We've been predominantly long Bitcoin and Ethereum, but we have also been long Litecoin and a couple of others. There's been a few special situations. But, when it's been moving up as powerfully as it has, you don't have to be too smart at the moment, but I think you're going to have to be very smart about exiting. And we're still very proud of the fact we're one of the only very few funds ever to write to our investors and say, would you please redeem and take some profits alongside us rather than sit passively. And we did that in late 17, at 14,500 and took some off the table. So and having somebody who writes to you and says, please take some profits, because they're aligned and have their own money alongside you, and Altana always has its money alongside, I think is more important than being passive in a super volatile instrument where someone's just taking fees off you.
Particularly the two major ones, Bitcoin and Ethereum. So Bitcoin seems to be like a kind of seen as a digital gold, rightly or wrongly, whereas Ethereum maybe has more uses. But I'm not an expert. How do you view it?
Look, I think the disappointing thing for crypto is the use case hasn't grown at the same pace as the internet. I mean, I think everybody saw the explosive upside and how exciting it was with the internet as well. And there was thousands of things that were being done on the internet very quickly. The crypto space, blockchain space, has been much slower, and we have seen container shipping, we've seen contracts, but and for sure Ethereum is definitely doing a lot more on the smart contracts. The anti-fiat digital gold Bitcoin has been better, it's been more robust, and Litecoin has really fallen by the wayside, it hasn't been used. So we look at wallets, number of wallets, people opening wallets with more than one Bitcoin, more than 100 Bitcoins, how long they've held them, have they traded. There's a lot of data. We look at the growth in wallets, we look at the searches, and that led us to the view that these two were currently the best horses in the race. It doesn't mean that won't change. And we've looked at others and come to the conclusion that they were maybe had poor protocols, easily hacked, or not enough take up, and they've fallen by the wayside. And last year Bitcoin was up 3x, Ripple was down 70%. So you had to be careful where you were. So it's not easy.
Interesting. Maybe we'll come back to that a bit later. Going more broadly on the market and all the stimulus, one thing that gets talked about a lot, and I believe you one or two charts in relation to this, is whether there's a tech bubble, and whether you believe that is the case, and if so, how you play it, how you view it, what do you do about it? When you have these few stocks that have dominated the market, that have become such a huge part of the market cap, what's your view on that?
Is there a tech bubble? Well, I think there's a bubble almost everywhere, frankly. But is there a tech bubble? Yes. It doesn't mean that's a bad thing, because you can trade bubbles from the long side and you can trade them from the short side. So it's not necessarily a bad thing. It attracts capital that may well eventually be used well. So the question is, are those stocks overvalued in terms of PE ratings, EV, EBITDA, whatever your poison is? And are their earnings sustainable? And I think my problem I have with tech is that both of them are going to be under attack this year. So number one, let's take a very cash cow type business like Microsoft that funds at maybe 50 to 75 over treasuries. Now, when rates are 2% and it funds at say 2.5%, you can maybe justify having a 30 to 40 PE multiple on that stock, right, to discount the equity premium. If rates go to zero and it's funding at 50 to 1%, you can maybe put a 100 multiple on that stock. Now, rates have been going up with this gravy train where everyone's found a greater fool to buy it from higher and higher multiples because yields have been going lower. Well, the last few weeks they've gone up. So the PE ratios have come down. Discounted cash flows mean the present value has gone down. So that's a negative for me this year. That's a negative on all highly rated stocks, full stop. And I think rates go a bit higher. Now, then we talk about earnings. So let's talk about earnings. Now, there's some really big issues coming up this year on tech earnings, and they're not getting enough focus. Now, we're seeing China, Alibaba, Tencent, we're seeing some of the political pressures. But in the US, we've got, and Europe, antitrust cases against Google, against Apple, against Facebook, and we've got Facebook taking out full-page adverts attacking Apple for removing the cookies, for Google changing its cookies so that Facebook can't do the same easy searches. We've got an antitrust case against Google because they pay $12 billion a year to Apple to be the first search engine on your phone. $12 billion a year. Now, Apple makes about $75 billion pre-tax. So you might say, well, $12 billion, but that's $12 billion of probably 90% margin. So if they were to lose that, it's 10% off its earnings, right? Maybe more off Google and potentially off Apple as well. Amazon is in a different space. It's got a big union vote this month where it's saying, do you want to unionize your workforce? That will be a cost to them, cost to their margin. Now, they're also now they're the third starting point for all searches in America now for goods. People go to Amazon to search rather than Google. That's a big problem for Google. So the competition's picked up. And then you go into the fact that all of these companies that were offline, that had suddenly got hit by COVID, they've all massively improved their online service. They've suddenly got a lot better at it. We've got companies out there who've listed like the Hut, in other words, and they're competing against Amazon and piggybacking off these logistic networks. So it has become a tougher environment. And so I do think here we've got a lot of earnings pressure coming in. And don't forget, the US government doesn't like the fact that they're so powerful and wants to put these things in there. Doesn't fact the Australians have come out and said, you've got to pay for newspaper ads, which is not newspapers and everything else. I'm going to fine you. So they've all got higher cost base. So I do think there's some earnings pressure, and I think there's some PE pressure. So yes, I do think we're in an overvalued situation short term. It doesn't mean these aren't great companies. Doesn't mean they're going bust or anything, but they're just under a lot of pressure. And I think 2021 is going to be a difficult year for these stocks if some of these things go out against them. I mean, if you look at the Amazon chart, which we're just pulling up, it hasn't made a new high since last October, and it all down to Apple. We haven't made a new high in the last 3 months either. So these tech stocks have come down either because of worries about earnings or worries about the ratings because the interest rate's gone up, or a combination of both. So there is a situation here where we just need to be a little bit careful because sovereign wealth funds, hedge funds, huge concentrations of asset managers are in 5 or 6 stocks. So could we see them pull back? Yes. That wouldn't be a terrible thing, Neil.
No, perhaps not. I mean, as you say, the fact that they're overvalued doesn't mean they're not still great companies, and you can trade them in short term.
No, they are great companies. Yeah.
So interesting thoughts on that. But moving on, trying to run through all the different things we want to talk about. You're also very interested in distress market opportunities. You have a very eclectic approach, obviously picking up different sorts of things. And from the distress side is probably what you described to me as your favourite trade at the moment. I thought it might be an interesting one for this audience because there are some similarities with a neighbouring country to South Africa, but maybe some big differences as well, which you can maybe explain.
The Zimbabwe, yes. Okay. So we look at distressed sovereigns, and we've been involved in a number of them, Iceland, Ukraine, Greece, and they tend to follow the same sort of pattern. They deny that they're going to go bankrupt. The bonds trade down, the dollar bonds or the euro bonds, usually US dollar bonds, trade down to 80. They deny they're going to go bankrupt, and then they default, and they trade at 30 to 40 cents on the dollar. And sophisticated investors, hedge funds, etc., they tend to buy into these bonds and agitate to get a higher return. And Ukraine was a great example. It traded down below 40, and we end up getting nearly 90 cents in the dollar back. Greece traded lower in the 20s, but ended up doubling in value. Argentina, it's all the same story. Venezuela, exactly the same playbook. Defaulted, hyperinflation, destroyed enormous amount of value in the country, 25th largest GDP in the world at 480 billion or so, and it's now 50 billion. So, not dissimilar. Currency's gone into hyperinflation like Zimbabwe. Very different to Zimbabwe, and I'll come to that in a second, because it's got the largest oil reserves in the world. It's got dollar revenues. It really can pay back that dollar debt. We can export oil at the right price and pay that debt. Had 100 billion of oil revenues 5 or 6 years ago. And the oil company, PDVSA, was the 6th largest oil company in the world, 20 billion free cash flow, even after immense corruption. But the bonds that were trading at 35 to 40 in 2018 after default and early 19, something very strange happened. The US government put trading sanctions on all Americans to stop them buying the debt. So all these hedge funds and all these banks and all these asset managers wanted to trade US dollar debt in Venezuela at 30 to 40 cents, and Argentina 30, 40 cents, and the Ecuador at 30 to 40 cents, couldn't buy Venezuela. So it dropped down to 15, and then in COVID dropped down to 7 to 8 cents on the dollar. And this is the sort of number that Cuba trades at 4 or 5. So suddenly you've got a recovery value similar to Argentina of 75, 80, Ecuador, etc. But instead of getting in at 35, if you're a non-American, you can get in at 10. So it may take 5 years, may take 7 years, but you're not doubling your money. You may be making 5 to 6 times your money. So suddenly I have a competitive edge on 90% of my hedge fund peers by just being a non-American. And to me, that's a gift. It's one of the greatest gifts ever. Very rare you see a sovereign trade below 20 cents, a proper sovereign. I'm not talking a small sovereign like Cuba or Zimbabwe. I'm talking the 25th largest GDP in the world 5 years ago. We're talking about the Norway of South America. And it's trading at 10 cents on the dollar because American firms can't buy and they're having to sell. So, you know, it's US dollar bonds under New York law with positive rulings. It's the most fabulous trade I've ever seen in distressed sovereign debt. Full stop. We've just never seen anything like it. And, you know, we've got a fund and we've got a vehicle and we've been accruing the bonds. And as I said, the court cases in October, November, and recently in January, they're in New York, have, funnily enough, all gone in favor of US bondholders. And I expect them to continue to do so. And what's really surprising is the Venezuelans themselves wanted to repay the debt, wanted to pay the coupons. And it was only because of US sanctions, not being able to use the SWIFT network, that they couldn't pay the coupons in 2017. They've even recently said, we'd like to repay all the debt. So they're willing to repay, have the assets to repay, but are trading at 10 cents. Whereas Argentina, on its 9th or 10th default, and its 3rd in the last 20 years, are trading at nearly 40 to 50 cents with no real dollar export assets. They got some beef and they got some farmland, and would have been nothing in the same caliber. So I love the trade, and you know it's difficult to access, but I think it's the best EM sovereign trade possibly ever, but certainly that's in the world today. And there isn't a lot of distressed bonds that you can buy below 20. There's some oil and gas. There's a few names in the emerging market, but really distressed issues that have non-zero recovery. I'm not talking subordinated or second lien. I'm talking primary assets that have non-zero recovery. There's 70 to 100 billion of hedge fund money that's looking to put into these names, and they can't fill it. So it's a really, really special situation, and I love it. My favorite trade.
So
it is.
And it's
my favorite trade.
And just to clarify, it's not. Obviously, there are some salient differences from Zimbabwe. So obviously, from being in South Africa over a number of years, you hear people say, "Well, it can't get worse. It can't get worse. You've got to get in now because it's at the bottom. It's at the bottom. It's at the bottom." And then they come back a year later saying, "No, it just kept going down, kept going down."
It can get worse. It can get worse, of course. It can always get worse. And then the humanitarian situation is horrible over there, and COVID has made it worse. Electricity, power cuts, all the rest of it. It's a disastrous situation. But the situation is different, purely because the assets are there. They are, and the second thing that's different, can it get worse? Yes, but Cuba today, that defaulted in 86, is trading 3, 4, 5 cents. So could it trade from 10 down to 5? Yes, and it was at 6.5 in the middle of COVID last year. So it could trade down a little bit more. But at 10 versus 70, which I think is the recovery, 60 to 80 recovery range, you could be too cute at trying to pick the bottom. And if you're going to make if it's going to take 5 to 10 years to double your money at 35, where the hedge funds got in, it's a terrible trade because you're not making a decent return. But if you're going to make 6 to 7 times your money, then whether you get in at 10 or 12 or 15, I don't think it really matters, Neil. Obviously, you'd rather it was 10 than 15, but it doesn't really matter.
I'm sure you've had some interest in that idea. Anyway, it's a fascinating trade.
Yeah, I'll send you a subscription form.
Moving on to another one of your original ideas, the Global Billionaires Fund, which I think it's picking on the notion of what do billionaires invest in? Let's get some of that. Or do you want to explain what it really is and how you go about it?
Yeah, I think there's two things here for me. I think one, as I said earlier, I think currency is important, and I think having global exposure is a way to diversify your risk, right? It doesn't mean you're right, but most of us are underweight China. Most of us are underweight emerging market currencies and assets. And a lot of these countries, a lot of these big businesses have, harder currency sales and softer currency cost bases. So I like the idea of a global portfolio. And then I said to myself, if I want to have a global portfolio that is going to reflect the growth of China, India, other, sub-Saharan Africa, whatever it might be, how do I choose that? And how do I say? Now, if I go to MSCI, do you know what MSCI even stands for? You probably don't even know the answer to that.
Capital International.
There you go. You actually know. Not many people do. But they choose a benchmark based on some factors, some of which is political, some of which in daily trading volumes, and those people have no skin in the game. So I said to myself, I want to be and Altana's all about, I keep saying it's all about being co-invested. If you're not in a co-investment with somebody, then it's harder to make money. It's harder to make money when the other person is trying to make the most for them and not for you. So, if you invest in a bank, they're not really excited about getting the cost-income ratio down. Now, that's a problem for you as a shareholder in a bank. And, I want to be invested with people who are alongside me on the ship, whether it sinks or sails. I don't want to be watching as they're at the sail. So I said, I want to be co-invested. So I want to be in firms where there's significant skin in the game from the management and the owners. And I thought to myself, well, who are the best owners you could have? Who are the most successful people in the world? Who've got access to the best advisors, the best potentially inside information in their country, the best access to the best people, cheapest financing? Well, let's start with the 100 most successful people on the planet. Let's get the Forbes list or the Bloomberg list, and let's get the 100 most successful people on the planet and see what listed stocks they own. So that's what we did. So we're aligned with them, and they're successful. There's no politics involved. It's totally meritocratic. And we put 1% with each of the top 100 billionaires. And if they own 2 stocks, we pro rata it. If there's 2 billionaires like the Google founders, we just have one allocation of 1%. So we have about 130 stocks, and we rotate them every year. Very global. And so, we're enjoying the growth of China, which may be a mistake, but at least it's reflected in the portfolio, the rising number of billionaires and successful people there, and, India and all these other countries. So I'm struggling to find a better way of allocating to a global portfolio than based on the most successful people. And so not only they're successful, but they've got 15, 20% of these companies. Why are they the most successful people, right? These companies, by nature, didn't require a huge amount of capital to get them going and fixed capital. They generate cash flow quite early on in their lives, and therefore they did not get diluted down to such a small percentage. So those businesses themselves are fundamentally sound businesses. If you could invest in Mars, the chocolate, which we cannot, unfortunately, it's a great business, throws off cash. It's not a GE sucking in capital all the time and lots of debt. So these companies are fundamentally the leader or number 1, 2, or 3 in their sector or their country, and throwing off lots of cash with big moats. So they tick all the boxes that you want as a long-term investor, but also with the stewards with their own money alongside you. So I love the concept.
You must rebalance from time to time. Like say last year, for instance, Tesla goes up 6 or 8 times or whatever. You must take some money off the table with that.
Yeah, I mean, look, it was very uncomfortable owning Tesla last year, and or comfortable depending on your view. I mean, it went from 1% holding to 6 or 7% in the fund. But what's nice is at year end, every year, we rebalance back to 1%. So as of January the 1st, Tesla was a 1% holding for us. So, we took profits in this case, and in some other cases, obviously some things fell out of the portfolio, at a loss, and new guys come in. So we're recycling into the winners and having some losers. But, our losers go from 1 to maybe 70 basis points on a bad loser, but our winners go from 1 to 200, 300, and in rare cases like Tesla, 600, 700 basis points of the portfolio. So there's a natural rebalancing, yes, as well.
Okay, just a small clarification.
Good, thank you.
And then the other thing that I wanted to touch on, I want to, before we finish, go into China and EM and South Africa as well. But SPACs, you have a specific approach there as well. Special purpose acquisition companies, all the rage. Some people would say a very frothy kind of thing because it's reflecting all the capital that's been pushed into the market by the stimulus, and so there's lots of capital looking for ideas. But without necessarily there being the good ideas. How do you view it, and how do you play?
Well, first of all, I'd like to say that I think people are right. It is very frothy. There are going to be some terrible SPACs, some terrible ideas that reverse into these companies, because by nature, wanting to reverse in quickly and raise capital is probably not necessarily what you want to see. You want to see a company that's not desperate to list. You want a company that's coming in later. So I do agree that SPACs have attracted a lot of capital because of zero rates, and there's going to lead to conflicts of interest and a lot of all the bad things you see in the press. But there's something that people are missing. And there was actually an interesting article in the FT a couple of days ago about it as well, about what the hedge funds are doing. And there is some interesting event-driven optionality. And I remember, me from my event-driven background originally, merger arb and everything else. So just for the uninitiated, a SPAC is a escrow account. There were some old SPACs that had some terrible abuse of shareholder rights and everything. But the new SPACs, the money goes into escrow. A sponsor spends $4 or $5 million, maybe more, raising the money, filing the listings, speaking to the SEC, speaking to the exchange, and that money is a loss to them upfront, a real loss. And it raises 100 million or 200 or 300 million, but that goes into escrow. So people are happy to put the money in because it goes into escrow. And when they get presented a deal by the sponsors, they can say yes or no. And even if 99.9% of the investors say yes, you can say no and take your $10 back, plus interest, which is worth nothing at the moment, but in theory, worth nothing. So those options are interesting to us, because if we buy them below 10, we know we can get 10 back. And as of today, there's about 100 of the 500 are trading about 9.8. That's interesting. If we go into the IPO of a new SPAC at 10, we get 10 cash in the new unit plus a warrant, usually a half a warrant or a third a warrant. So we get a present value of about 10.3, 10.4. That's free money if we can get into the IPO. That's interesting. If we buy a basket of them around 9.8 to 10.2 and they trade up to 10.7 or 11, we sell them and buy the cheaper ones and recycle and make a little bit of money each month. That's fairly risk-free as well. During COVID, they traded down to 9.1 for about a week as people panicked and liquidated their portfolios. Within a week, they were back to 9.8 and back above 10. Now, where it gets really interesting is every now and again, and we can see from the charts here if we take something like ArcLight, every now and again, a deal gets announced, and everyone's so excited about the new company, it traded up massively. So you can see it traded up from low 10s, and the deal got announced, and it traded up all the way above 20. Now, remember, that was just the announcement. There was still another 12 weeks or more before the vote to decide whether the deal, and there's paperwork to do, and and they go out and raise extra capital alongside and do road shows. So you've got a 12-week trading period where you could just watch it trade up or down, and you don't have to take any risk. And we would obviously have exited the position at that point in time, maybe not at the peak, of course, but at some point at the time. And then Similarly, just to pull up the one below, the one that's most well known is Virgin Galactic, which was, announced a deal, and traded up, dramatically as well. So they trade about that 12 weeks or 16 weeks, whatever it takes. There's some optionality there. So some of our portfolio will just get lucky and they'll announce deals. So we'll have 50 to 80 names, and some of them will trade around and make some money, and some of them will make 3-4%, and some of them will make explosive amounts. Now, the fact we're floored at 10 and mark to market maybe at 9 means that it's a very nice way of replacing your fixed income portfolio that's yielding 0 with a series of AAA cash in escrow convertibles, where you have a last look at the deal. And there's a number of people who want to get into the new company who will buy these off you at 10.1, 10.2 to get involved in the new company. Why? Because typically on the first day of trading of a new issue or a reverse company where they've raised money, they typically trade up on average about 12%. So the average first day move is about 12%. So if we can get into those at 10.5, so 5% premium, we might hold them for that first day of trading and sell them. So there's the IPO of the SPAC, there's the trading around the ranges of the SPACs, there's trading around getting the luck of the announcement of the new deal, trading around the new deal, and then trading on the first day of the new company. Now, all of those options can be exploited by somebody screen looking at the 400, 500 SPACs a day and around them, and that's what we do, and that's what some of our competitors do as well. And we think that optionality is missed. Now, will there be some terrible deals because the sponsors just have to get a deal done within 2 years? Of course. And will some of those SPACs have traded down to 3, 4 from 10, but we won't be in those at that point in time. That will be someone else's problem. And so that will be an issue, and that hot market for new issues will dry up at some point, and there'll be some bad deals. But what's nice about it, then the next 4 or 5 SPACs that announce deals will have to do them on much better terms, and therefore you'll get some good deals. So there is a lot of optionality in these, and that makes it very interesting to us as specialists, I guess.
Okay. Well, thank you for clarifying that, Lee. I'm conscious of time running down. I just thought for this audience, it might be interesting to finish with some thoughts. You touched on it a little bit already about emerging markets in general, your thoughts on China in particular in relation to the billionaires funds and so forth. And maybe you have some thoughts on South Africa too. Do you want to just give the audience the benefit of your thinking on EM? And
it's a tough one to talk to the home audience, the World Cup champions. It's very difficult to say. Look, I think it's still got an issue attracting foreign capital. It's still very cyclical commodity country that needs to be done. I think a lot needs to be done to cement its place as the financial capital of Africa. I think a lot of things need to be improved. I'm not sure this current government has the wit or wherewithal to really do that and drive. And I think that's still a problem to attract capital. And your previous panel, I know they talked about VC returns, private equity returns being similar to the US without leverage. Well, that's the problem. It's attracting capital, and there is so much debt issuance coming out later this year in the USA. It just worries me for all EM that you've got a capital flow problem this year. That you have to put money in. I mean, this 1.9 trillion plus whatever spend. I mean, the second half of this year, the debt issuance way drowns the Fed buybacks. So there's going to be a difficult period for EM this year. I think, to fight that dollar drive, and it's going to be bad for euro as well. I'm not picking on EM. There's just going to be a whole lot of money sucked out of the system into the US this year. So I think it's a difficult year. Now next year, with vaccines and global growth, could that be priced in and help the rand in the second half of this year? So yeah, it could happen, right? And it's happening now with platinum and everything else. Could we start pricing in the 2022 recovery this year? Potentially in the second half. I just think it's, I'd like to see how badly we all get hit by this dollar debt issuance later this year. It's kind of one of the biggest worries, in our risk meetings, is how will that affect capital flows second half of this year?
And just one follow-up on that. Does the rise of China sort of affect the dynamic there a bit? Maybe, obviously, South Africa sells a lot of commodities, particularly metals, base and precious, to China. Does that change the dynamic at all going forward?
The rise of China. It's risen, hasn't it? I think the demand for copper and platinum and all these other things is not going away, right? I mean, 40 years ago to today, the demand, is so stark. The pace will slow down, Neil. I mean, the pace, is something like, you look at Japan and Germany post World War II. China's pace has been greater for 40 years than Japan and Germany was for 15 to 20. So at some point the pace slows down, but we're maybe talking about high single digits of copper and platinum usage versus double digits, right? It's still phenomenal on a compounded basis. And don't forget India as well, and Indonesia and all these large populations. They're not going away. They want they want better standards of living. They want all the things that we have, right? So ultimately, if countries like South Africa, commodity producers, can get it right, it can be very, very good, right? I've just seen too many bad governments, Venezuela and other places, make a mess of really good situations. It's very hard to predict, right? And Trump did a lot of damage to the US globally, arguably the COVID stuff in Europe has been a disaster from European unity. So it's easy to get things wrong in any 5 to 10 year period. I think it's a mug's game to predict what can go well. I mean, Turkey was a bright light 5 years ago, and now it's traded up as 8 to 1. So it's tough to time, I think. Get your timing right.
Well, Lee, thank you very much for that very, very thought-provoking comments, as always, reliably controversial, I think.
So hopefully not controversial.
If we were sitting in the hall in Cape Town at the Vineyard, which is a wonderful location, you must come down in person sometime. You'd be inundated with questions from the floor. So I know that you're happy to take them via email at a later point when this has gone out. So we'll forward them on to you as a
Yeah, look, good luck with the conference. It's a shame it's not physical, because it does take away a lot of the networking, but I'm sure it will go very well. And thank you for inviting me on. Yeah, I'm happy to take emails if you want to pass down my email. Obviously, it's lee.robinson@altanawealth.com, and you can find me. And I'm happy to come on again in the future if you need me to.
Thank you very much, Lee. We'll be looking forward to having you again. Thank you.
Thank you.